Hello, everybody. Welcome back to the podcast. Ryan Haley here with Atlantic Shores Sotheby's International Realty and bringing you the Running Real Estate podcast. Today, we're going to switch things up a little bit. We've had guests on here for just about every episode here, but today, as we transition through the first quarter of 2023, I thought it would be good to not just give us the typical weekly real estate market report for Delmarva, which I typically give, but actually break it down and get into some more details, because one of the main questions I get when I am with clients, when I'm with friends, when I'm out and about at social events is, hey, Ryan, how is the real estate market? And I think all of us are guilty of this, not necessarily by choice, by just default in what happens. And that is that we are living in an information overload world. Between social media, your smartphone, whenever you go into your smartphone, they're suggesting that you look at videos, they're suggesting you look at stories, and everything is customized to you. So interestingly enough, if you ever decided to search for real estate, you're going to be delivered real estate content. And some of it is going to be good news, and some of it, ironically enough, will be bad news. And what we know by being in this business is that headlines do more to terrify than they do to clarify. So I want to do some clarification here. I really want to give you an update as to truly what's going on and debunk and get rid of some of these myths that people hear. So that being said, obviously, the economy as a whole, there's a lot of moving parts. We've seen the Fed continuing to try to stamp inflation and bring that down. We've seen some bank crises here as of late. And then the R word has kind of showed itself again, the recession word, which honestly, we've been in a recession before, but they've decided to change the rules as to what a recession is. So lots of information. I'm going to try to give you my best that I have here, but that's the big question. What is going on in the real estate market? And in this episode, I hope to answer a couple things for you. Number one, what are we seeing locally here from a sales trend-wise? Number two, how do we compare with sales today versus pre-pandemic levels? What does the current demand look like? What's happening with prices? Are we seeing prices go up? Are we seeing prices go down? What's going on with affordability? Can people afford homes with these higher interest rates and higher prices? And then nationally, what do we see as far as home sales? Distressed sales, something we haven't heard in a while, but every once in a while I'll get that phone call and say, I'm going to wait for a foreclosure. Send me all of the foreclosures and short sales. I want to buy a distressed property. Haven't seen a lot of that, but I want to talk about it a little bit. And then inventory levels. Are inventory levels and monthly supply increasing? Are they going down? And then finally, I'm going to wrap things up a little bit here with kind of a recap as to where interest rates are and then what our projections are as we move into the rest of 2023. So going to start off with the typical update here for Delmarva for the second week now into April. We're going to start with Worcester County. In the last 7 days, we saw 51 new properties come on the market, while at the same time, we had 64 properties go under contract. The trend, as you know, if you've been watching these reports, continues. We are outselling the current inventory here in Worcester County, Maryland. All inventory countywide, there are currently 263 properties for sale, while at the last 30 days, we had 204 properties go under contract. That gives us currently 1.3 months supply. Remember that for the future. As when you watch through this entire video, I'm going to talk about inventory nationally at the end, but currently 1.3 months supply. Moving into Sussex County, Delaware. Currently, in the last 7 days, we had 126 new properties come on the market, while at the same time, 153 have gone under contract, outselling the inventory. Countywide, currently 1,234 actives for sale, while in the last 30 days, we sold 456 properties, or had 456 properties go under contract. That gives us 2.7 months supply in Sussex County, Delaware. Rounding out Delmarva, Wicomico County. Last 7 days here, we had 21 new properties come on the market, and 33 have gone under contract and or are pending sale. And this is kind of an interesting situation here where we have 117 current actives for sale in Wicomico County, but we've outsold that number by 100. We had 119 go pending in the last 30 days. So that's giving us less than 1 month supply, 0.98 months supply in Wicomico County. We've moved under 1 month. So that is the last 7 days here on the shore, on Delmarva, our 3 counties. I thought I would now look at what has gone on here in the first quarter, Q1 of 2023, as far as actual closings. We have a tendency to look at what I call lead measures. What's truly going on. The lead measures are the contracts being written, the ones going under contract, the inventory currently, as opposed to the lag measures. The lag measures are what is actually gone to settlement, what's made it to settlement. And if we look at year to date, Worcester County, we've had 447 closed transactions. These are properties that have gone to settlement. How does that compare to 2022? Well, in 2022, we had 635 closings in the first quarter. So currently, we are down 30% year to date as far as number of transactions. I thought it would be interesting to now take that not just year over year, but let's compare that to pre-pandemic levels. Let's go back to 2019. So keep in mind, this year to date, 447 closed. Back in 2019, we had 532 properties closed in the first quarter. So we are actually down. We're still down 16% of what we saw in 2019. So down 16%, even when we compare it to pre-pandemic levels. That's Worcester County. Sussex County, Delaware. Interestingly enough, we had 1,233 sales here year to date. In 2022, we had 1,607. So we are down just a little bit less than we are in Worcester County. We're down 23% over what we saw in 2022. Compared to 2019, pre-pandemic, we had 1,186 settlements. So actually today, we are up 4% as far as number of closings year to date in the first quarter of what we saw pre-pandemic. So up 4% here year to date compared to 2019. Wicomico County, year to date, 243 closings. Compared to last year, we had 349. So we are down 31%. That's the greatest decline that we saw as far as number of transactions. Comparing that to 2019, pre-pandemic, we had 250 closings in the first quarter. So we're down just a little bit, down just 2% over what we were in the pre-pandemic era. Interestingly, and we'll talk about this here in a few minutes as well, a good portion and a good reason that we actually have seen less transactions is the lowest inventories that we've had in quite some time. We are just not seeing as much hit the market, and when we do have properties hit the market, they're getting gobbled up. That absorption rate is fairly high. So I'm curious to see what it looks like as we move into 2022, but a good portion, a good reason for our transactions being down year to date is not enough to buy. There's buyers that want to buy, but just cannot find that inventory. So that rounds out the update for the last 7 days and the first quarter locally. But now let's look at the national levels. What are we seeing from a national level as to what's going on with the current market? Demand based on the rate environment. And this I like to track. And if we go back to the beginning part of the year, we were in a category that they referred to buyer demand as good, which then actually, as we moved into March, it started to show some weaker demand. And then nationally, we are back into that good level. So the demand has remained strong throughout the entire country. And part of that is the turbulence in the financial markets is putting significant downward pressure on rates. So there's some turbulence in the financial world that's putting downward pressure on interest rates, which in turn is giving more affordability to buyers out there. And they're benefiting, this is benefiting borrowers in the short term by seeing lower interest rates. And this is coming from the chief economist from Freddie Mac. So what does that mean for home prices? I think that's the biggest the biggest question that I get is are prices going up? Are they going down? And some of that obviously has to do with our location and where we are in the country. So I thought I would just go through a couple of so this is the year-over-year appreciation for the top 20 cities in our country. So this is, remember, year-over-year from the beginning of the year of this year to the beginning of the year last year. Atlanta is up 8.4%. That's the biggest, one of the biggest winners. Boston up 4.2. Charlotte up 8.1. Cleveland up 4.8. Dallas up 5%. Denver up 1%. Las Vegas 0.4%, so not quite as much of an increase there. Los Angeles, 0.9%. The biggest winner as far as year-over-year appreciation is Miami at 13.8%. New York, 5.2%. Phoenix is flat, 0%. Here's where it gets interesting. If you look at a map, it's pretty interesting. Anything to the left of Texas seems to have seen a greater slowdown as far as price appreciation, and or in some cases it's actually we're seeing prices decrease. East of Texas seems to be holding its own, especially the southeast, and that's evident with that 13.8% year over year in Miami. Same with Tampa, 10.5% increase in the last year here. But Portland down 0.5%, San Diego down 1.4%, San Francisco down 7.6%, and then Seattle down 5.1% as far as year over year appreciation. This is coming from Selma Hepp, who is the chief economist for CoreLogic, and the quote there is, declines in the West are due to the tech industry slowdown and a severe lack of affordability, meaning prices got too high along with interest rates. And that's after decades of undersupply. So for the last, I would say decade, I don't know about decades, but for the last 10 years for sure, we did not see enough homes. Inventory with that has decreased, actually increased. And so the declines in the West are due to the tech industry slowdown and a severe lack of affordability. Moving into the region here, if we look at year-over-year appreciation, and I'm going to put these slides up so you guys can take a look at this in the blog, but year-over-year price appreciation, national rate of appreciation, when we look at the entire country, is 5.3%. The greatest area where we saw appreciation year over year is the South Atlantic, where we're up 9.6%. The Mid-Atlantic is up 6%. New England, 7.1%. East, South, Central is up 7%. The East, North, Central, up 5.5%. If we move into the West, like Mountain, we're at 1.4%. And then the Pacific has been flat. Now, year-over-year, price appreciation has been strong. But if we move and look at the month-over-month price appreciation, that's where we're starting to see a slowdown. And this is from January, the 2023 month-over-month percentage of appreciation in our top cities. And so this would be from December to January, essentially. What happened in that 1 month? Atlanta was flat. Boston just 0.3%. Charlotte 0.2%. Chicago was flat. Cleveland 0.1%. Dallas down 0.6%. Denver negative 1%. Detroit down 0.1%. Las Vegas down 1.1%. Los Angeles down 0.3%. And that pretty much holds true through Miami, New York, Phoenix, Portland, San Diego. We've seen this decrease in price appreciation month over month. So although the year over year has been strong, the month over month has definitely shown a slowdown. Now, keep in mind, these numbers are from the first quarter and the beginning of the first quarter, so we'll have to see where things shake out as we get into the second quarter, which is the peak of our spring buying season. All in all, this is from Black Knight, and this is coming from the February monthly mortgage monitor. All in all, home prices nationally are down 2.6% from their peak in 2022. So down 2.6% when you look at the month over month, and the total amount down from their peaks of 2022. That was taking into consideration an average of 3 reporting agencies. Moody's said we're down 2%, Freddie Mac said 2.5%, and then Black Knight was at 2.6%. Will we see affordability increase? I think that's a question that a lot of people have, and I think it's going to really depend on where you are in the country and how much supply we have. when combined with the mortgage interest rates and where rates will go. But one thing I'm looking at here, and this is from the National Association of Realtors, that tracks all the way back to January of 2021, what the average monthly mortgage payment amount was. And currently, we are sitting at $1,807 as the average monthly mortgage payment that Americans are paying throughout the country. This peaked back in October at $2,043 a month and has since been declining every month. And that's based on prices softening in certain areas, as well as interest rates, which have declined. Keep in mind, the end of last fall, we were seeing interest rates that were at or above 7%. I'm going to talk about that in a minute here, but it's been great that we have actually seen these interest rates come down a little bit, which is providing relief for home buyers and or people who are borrowing money through a mortgage right now. So October, they peaked. $2,043 was the average a month. Then in November, it was $1,993. December, $1,869. And then the lowest level here that's been reported thus far at $1,807 a month on average. So what that translates into is actually it's becoming more affordable currently in the last 4 months here or so to be able to purchase a home and have a mortgage. Home sales and days on market. So the February stats for average days on market nationwide was 34 days. We've seen that increase every month going back to August. So in July, we were at average of, this is nationally, 14 days was the average days on market, which then went to 16 days. In September, we were at 19 days. November, 24 days. December, 26 days. And then in January, 33 days on market was your average nationwide. And in February, we were at 34 days. So the rate at which it's increasing is slowing down a little bit. I thought it was interesting to see when this actually peaked. And we have to go all the way back to February of 2019 at the highest levels that we saw. At that point, it was taking on average 49 days for a property to sell. So what I find fascinating is we talk about the COVID years here, the pandemic years, the last 3 years, but even before we were into the pandemic market, we still had a very severe lack of inventory, and homes were selling at a fairly good clip. Keep in mind that anything less than 6 months supply, 6 months supply and less is considered a seller's market. Anything over 6 months supply is considered a buyer's market. And when we're looking at the average home selling in 34 days, that's pretty quick. So even prior to the pandemic, we definitely had low inventory and homes selling relatively quickly. Now, existing home sales. This is a number that I find interesting because I'm always looking at the number of transactions that every realtor can do. Number of realtors, number of real estate agents has increased drastically here since the pandemic. It was a profession that a lot of people wanted to get into, but when you look at how many agents there are and how many for home buyers and home sellers, how many homes are actually going to sell on an annual basis, the existing home sales basically peaked in January of 2021. And at that number, we were at 6.8 million existing home sales. Fast forward to today, and the projection here in January, we're selling them currently at a pace of just over 4.5 million on an annual basis. So if we continue to sell at the level we're selling, we will sell about 4.5 million homes nationwide here in 2023, down from the peaks of almost 6.8, 6.9 million. So definitely a decrease in the number of transactions that we're seeing. And once again, I wish we had some more inventory so we could sell a few more properties here. Existing home sales year over year by region. This is interesting. The West has seen a decrease in number of sales on average by 28%. The South, even though it's the most robust or one of the most robust areas, we've seen a decrease in existing home sales year over year by 21%. The Midwest is down 18.7%, and the Northeast is down 25.7%. That gives us an average nationwide of a year over year decrease in existing home sales by 22.6%. Distressed properties. This is, as I mentioned earlier here in the podcast, is what percentage of distressed properties are actually contributing to the property sales. And interestingly enough, distressed sales, foreclosures, and short sales represented 1% of the sales in February. This, if you take it back all the way, this is an interesting number. If you go all the way back to and this goes back to January of 2012, at that point, the percentage of annual sales that were taking place that were distressed properties were as high as 35%. And I remember those days. I honestly remember that there was more on the market, and really the properties that were selling were the distressed properties because they were priced the most aggressively, and those were the ones that we were helping a lot of buyers secure at that time. But it peaked at about 35%. That continuously has come down over the years. Pre-pandemic, so back in 2019, we were seeing about 5% of the total sales that were foreclosures and short sales. Currently today, like I mentioned, we are just over 1% of the total sales that are going to take place that are foreclosures and short sales. And with the current inventory and the current demand, we're not anticipating that number to necessarily increase. So those of you who've kind of been waiting and wondering, are we going to see more foreclosures come into the mix? We may, but it's still not going to be a huge percentage of the overall market. So where are we going to, what's forecasted year over year percentage change in price? And currently nationwide, if you average everything in, we're at a pace of 4.4% appreciation year over year price change in price. And that was based on February numbers. So we're seeing an increase of 4.4%. The forecast is to be around 3.7%. So we'll have to see if that slows down at all and kind of normalizes to that 3.7%. But that is the forecast as far as appreciation goes. Change in inventory, so number of homes that are currently for sale. Nationwide, we're down about 2.7% month over month. And then if we look at the actual last 12 months, percentage of inventory, we're actually up a little bit. We have 2.6 more homes for sale in February than what we did the February before. So that's a good news for you buyers out there that are trying to find that home that's going to work best for you. Finally, what I wanted to do is I wanted to wrap up here with interest rates, mortgage interest rates. And the question that I get is where are rates today? And then where do we anticipate that they might end up? Now, as I'm recording this, we had the jobs report that came out last Friday that showed that the number of new jobs created in the last month was pretty much on par with what was forecasted. But then we also have the CPI report that's going to be coming out here tomorrow. So I know I'm stamping this. I'm putting a time frame on this podcast, but we don't know what those numbers look like. I don't necessarily know if it's going to matter at this point as to what the mortgage rates do and what the Fed ultimately decides to do here when they come out with their meeting in May. But for mortgage rate projections, and this is as of April, currently, right now, as of today, we're seeing 30-year fixed rates that are just under 6.5%. And the projection for Q2 here, when we look at Fannie, the Mortgage Bankers Association, and the National Association, and we average those all three, we are expected to see mortgage rates that are going to be about 6.3%. So 6 1/3 is what the average 30-year fixed rate should look like based on the forecast. When we go into Q3, we're actually starting to see that decrease closer to 6%. 6.7% is the average there. Interestingly enough, the Mortgage Banker Association and NAR both believe that we'll see interest rates consistently under 6% as we get into Q3. When we get into Q4, even more of a decrease. 5.77% is what is expected to be the average 30-year mortgage rate. And then Q1 of next year, even a little bit less. 5.57% is the projection as far as where mortgage rates could be. So rates are projected to come down. Not drastically. I don't think we're going to see that. I know for a fact we're not going to see that 2.5%, that anomaly that everybody's got that friend that says, oh, I got 2.5%. That very few got that, but some did. I don't even think we're going to see rates in the fours, but we could see rates in the mid to upper fives in the next year, which I think is a very sustainable rate. I remember when I bought my first home in 2023, or 2003, I bought my first home and I had to do an ARM. I did an adjustable rate mortgage to get the best rate that I could possibly get, and that was 2003, and I was at 6%. So your 30-year fixed was actually higher than that, but to get the best rate, I was at 6%, and I was happy with that. And I think that's what a lot of us have to look at. We have to look at what are our goals, where do we anticipate we want to be as far as our inventory of homes that we own, what's most important to our family, and then what's most important as far as a monthly payment goes. What do you feel comfortable paying? And that's ultimately where I think a lot of us should focus as opposed to what the actual interest rate is. I heard this the other day, and somebody said to me, it's like, well, can you remember what your car interest rate is? And honestly, I've got no idea. Some people do, but I think most of us have no idea what our interest rate is on our car. We just know we can afford it and we can swing that monthly payment. So the same holds true here when it comes to housing. Housing is probably the largest financial investment that you'll make, but it's also the most personal and the one that really defines who you are as a person, as a family, as your where you spend the majority of your time. Besides work, you're at your house the majority of the time. So the ability to secure that right home and feel comfortable about the monthly payment, I think is probably what's most important to a lot of us. So there you have it. That is a very lengthy, wordy market report for you, a kind of a recap as to the state of the market, what we're seeing here for the last 7 days, but then Q1 in our local markets, and then kind of what we saw nationally and what we're projecting as we move into the second quarter here of 2023. So if you think this information is helpful, please like it, share it with your friends, subscribe to our channel. If there's any segments of the market that you would like to know more information on, please let us know. I'd be happy to break it down kind of on a smaller level here to either subdivision, towns, communities, and give you a snapshot as to what we're seeing in the real estate market. So once again, thank you so much. We'll be back next week with a live guest here on the podcast. Hope you have a fantastic week. Enjoy this spring-like weather at the beach. Talk to you soon. Thank you.